Now we're going to talk about the decision to replace or keep or retain a piece of equipment. In our example, Scout Corporation uses an older machine in its main production line. Given its age, the machine creates some inefficiencies. For example, it requires frequent maintenance, it has a significant amount of downtime, and perhaps there's higher labor costs associated with using this machine. Managers are deciding whether to replace the machine with a new one. So the information that we have in this example is that the original purchase cost of the old machine was $110,000. The point at which we've accumulated depreciation is $70,000 of that original amount. The estimated useful life from here on out is 4 remaining years. The new machine, its cost will be $120,000. Since we haven't purchased or put it into use yet, it has no accumulated depreciation. And its estimated life is 4 years as well. Additional piece of information is that the new machine will provide an annual cost savings of $35,000. Also, the old machine can be sold for $5,000 right now. If used for their entire lives, the machines will have 0 value. So the $5,000 is only recoverable right now for the old machine, and if we use the new machine for all 4 years, it won't have any value at all. So now let's explore the relevant information in this example and ignore all the information that would be irrelevant. Currently, our status quo is to keep the old machine. And so our change or our decision is to replace it. So let's think about what incrementally would occur if we were to replace the machine. First of all, we would have cost savings, the reduction of the downtime, the decreased labor costs, and the other inefficiencies that the old machine is costing us money would be saved by using the new machine. That amount was $35,000, and that savings would occur annually for the next 4 years in which we would have the new machine. That total is $140,000. What else is relevant to this decision? Well, we're either going to keep the old machine or purchase a new one. And so the purchase price of the new machine is something that's different between the decision alternatives. It's an incremental cost if we were to replace the machine. So the cost of the new machine is something we definitely want to include in our analysis. Per the given information, that cost was $120,000, and that's a negative amount given that's something we have to incur. And then we have the sale of the old machine. That amount would occur if we were to replace it with the new machine right now. We would sell that machine for $5,000. And that would be a plus to our consideration. So net, $140,000 in cost savings, plus the sale of the old machine resources of $5,000, but subtracting the $120,000 cost of the new machine leaves us with a $25,000 net effect. And that is to the plus side. So ultimately, the net impact of replacing the current machine with a new one is $25,000 to the good. So let's consider some additional information in our example. Suppose that managers have identified an investment opportunity not related to machinery and equipment. An investment can be made only if the new machine is not purchased. That is, the investment is made with the cash used to purchase the new machine. So it amounts to $120,000. A question would be, what percentage return does this alternative investment need to lead the manager to retain the old equipment? Well, very simply, we can think about what happens when we replace the old machine with the new one. Like we said, it's a net incremental impact of $25,000. If we earn approximately that same amount via this alternative investment, we wouldn't necessarily need to replace the old machine. We could keep it and invest our $120,000 in this alternative investment. So the rate of return that would be required for this alternative investment would be equivalent to $25,000 in cash. $25,000 as a percentage of the $120,000 investment is equal to 20.83%. If the alternative investment earns 21% or so, or higher, then it makes it more worthwhile to keep the old machine, not replace it, and invest the $120,000 elsewhere. In this example, this additional information signaled the potential for there to be an opportunity cost, a next best alternative associated with the $120,000. And depending on how much it returned, it actually might be our best alternative.